Welcome back. My name is Aaron. You're with Cozy Financial Planning watching a video. We're back with another Financial Planning 101 series. We already did the RRSP. This time we're going to work on the TFSA, the tax-free savings account, or better known, or better how I like to know it, as the tax-free investment account. We're going to talk about some pros and cons of it, how it works, basics of it, some things that happen to be confusing to some Canadians about the TFSA, and maybe some pro tips or strategies you can utilize. Okay, let's get right into it. So the tax-free savings account was invented by the CRA in 2009, just as an additional type of investment account other than just the RRSP. It gave Canadians a way to get money in and out of a savings account or investment account without the penalties of an RRSP, right? As well as an additional way to save money. The basics of it is that you have to be 18 years of age and be Canadian or permanent resident to open the account. Now, how does the government stop people from just putting all their money into it and gaining all the investment off instead of using an RRSP? Is that there's a contribution limit. So in the year 2025, if you turn 18, you can open one of these accounts and you would have a $7,000 limit to contribute to for the whole year. Now, if you were 18 in 2009, you would have $102,000 accumulated max amount of room available to you. Now, in addition to this, we talk about investments. It can hold all common investments like GICs, cash if you want to. It's not really investment, but cash. You can hold stocks, bonds, and mutual funds as well. Now, what's interesting is that if you withdraw the money from your RRSP, not only is there penalties or taxes you have to pay back, and the tax-free savings account is tax-free, so you just get it out. There's no problem with it. Is that you're in an RRSP, your contribution room would disappear. You wouldn't be able to put that money back in there, right? If you had $10,000 in RRSP and you took it out, you would have zero contribution room left. If that was the maximum you had. And the tax-free savings account, as I mentioned, in 2025, it's $7,000. So if I put that money in 2025, and it's an 18-year-old, and then at the end of the year I took it out, in 2026, it comes right back to me. So I'd have that $7,000 plus the new amount of room available that the government, the CRA, set out. So probably in the $7,000 range again, as it slightly goes up with a bit with inflation. Now, those are the basics of it and how it works, and you can utilize it very much in your financial planning, just as an additional account. You can have upwards of 99 of these accounts. However, your contribution room is between all of them. So if the max amount of room is $102,000 right now, you could have 10 accounts, but you cannot exceed $102,000 between all of them added up. If that makes sense. So you can use TFSAs for a lot of goal setting and purpose. In that you can use one for children's education instead of an RESP if you want. You can use one for retirement. You can use one for saving for a house, trips, emergency funds. You can use it for lots of different things. So it gives a lot of versatility to it, which I very much like. Very simple to open one. Everyone can own one. It's very easy. It's very easy to put money into them, and it's very easy to take money out. So a lot of flexibility, a lot of variability to it. Now, some of the things that some people get confused about is one, it does not lower your payable taxes like RRSPs do. Some Canadians are confused by that. Not everyone, but some are. People confuse the two. Number two, when you're withdrawing the money, remember, even though you get the contribution back, like I said earlier, in the following calendar year. So if you have $7,000 today and you put it in if you're 18 and you take it out tomorrow, you can't put the $7,000 back. You might be able to put it back, but it's up to you to know the contribution room. The bank or any institution is going to do the actual transaction for you, but then you will receive letters that you've over contributed, and you will start accumulating expensive penalties and fees from the CRA. So be very mindful of that. Now, in addition to putting that money in there, and what you're doing is don't forget to invest the money. By that I mean a lot of Canadians just put it into the TFSA and don't realize it's in maybe cash position or in just a high interest tax-free savings account. And a lot of Canadians think that is all it is, right? Because it's tax-free savings account. They think it's only meant for high interest savings. As I said earlier at the beginning of the video, it should have been called tax-free investment account because all your investment growth is tax-free. So let me say that again. Your investment growth is tax-free. So you want to get those mutual funds, those capital gains, those dividends, those interests from GICs, anything like that, and you want it, when you take it out, you don't want to pay a cent. It is fantastic for that, but you got to make sure you're investing your money. Yes, if you're using a TFSA to save for a house or emergency fund, you don't want to invest it in those mutual funds, or you don't want to invest it in those stocks, right? You want to keep it safe. So maybe those tax-free, high interest accounts are best for it. But we're getting a little nitty-gritty of specifics. But when money has a purpose, it is very easy to stick to those goals. And we will talk about that in further videos as well. Now, one key thing about this, because it's with the CRA, it's registered to them. That's what makes it's a registered account. So it has tax preferences around it, kind of thing. So it's a tax-free savings account. Is that you can have a beneficiary. So it will skirt around the estate tax, and the money will go directly to your beneficiary if something ever happened to you. However, a better technique is that you're allowed to have a successor holder, which means, so the difference between the two is, if a beneficiary receives it, the money that comes out of the account and goes into their bank account, or goes however it gets there, right? Now they have to do something with that money. So if you were maxed out in 2025 at $102,000, and it goes to, you put your spouse as a beneficiary, they're going to get $100,000, but they might have $100,000 in a tax-free savings account, or $70,000 or $50,000. They might not have all the space. So what are they going to do with it, right? It's not going to do the best things for them. Or they might put it in there and accidentally over-contribute by a large amount. And what happens is successor holder is the person just becomes the new account holder. The whole account and all the money and all the investments go to them. So one, it doesn't get sold. So the investments don't get sold, so they stay invested. And you may not be familiar with this type of thing with like estate planning, but when the money's sold, like the investments are sold and the money gets to the person, fluctuations can happen in the market, right? Growth or down, you protect against that. But if you're not using the money for anything, you might as well just stay invested, right? That's the best thing to do. So you successor holders means it stays there the whole time. It's fantastic, right? So I highly recommend doing that, successor holder. Now, I think that's about it. When it comes down to the TFSA, we want to make sure we have one. We want to make sure we're mindful of the contribution rooms. We want to give the account a purpose, and we want to make sure it's invested, right? And we just want to do all that stuff. It's pretty straightforward. Now, how do you utilize it compared to other things? We can talk about that in other videos, but I want people to understand this, and they can hopefully better utilize it and go ask questions about their own accounts or look at their statements to make sure it's invested properly for their goals. Now, thanks for watching, and see you in the next one.